Welcome to the SMA 50 strategy. This system is simple, highly visual, and effective for both beginners and intermediate traders. Its power comes from using just one indicator, the simple moving average 50, as a critical filter. By focusing on the daily time frame, we ensure maximum clarity and only enter when the price shows real, undeniable strength, allowing for great risk-to-reward potential. The general rules are straightforward. We trade exclusively on the daily chart using the SMA 50. The strategy's core is to find a clear breakout or retest pattern at a key support or resistance level. Crucially, the setup candle body must meet specific technical requirements to confirm genuine momentum. We then manage risk by being disciplined and entering only on confirmation, not prematurely. Let's detail the preliminary conditions for a long setup. We need an undeniable buying signal, a candle with a long body and small wicks, showing strong control. The entire body must be completely above the SMA 50, confirming an uptrend context. Finally, the candle must be sitting on a key support level. This strict three-point filter ensures the signal shows true strength, eliminating market noise. Here is a clear visual of our first condition, a candle with a long body and small wicks. Notice the strong close near the high of the day, with minimal upper and lower shadows. This momentum candle, positioned above the SMA 50, is the first confirmation that buyers are in firm control, not sellers. The second, critical filter, is that the entire candle body must be completely above the SMA 50. As you can see, there's a clear separation between the price action and the yellow moving average. If the SMA 50 cuts through the candle body, it indicates indecision, and we must avoid the trade, only looking for this clear, undeniable strength. Our final preliminary condition is the structure. The candle must be sitting on a key support level. This often happens during a retest. The horizontal dashed line represents this strong support. The market returns to the level, forms a strong momentum candle above the SMA 50, and confirms that the structural support is holding, providing a high probability entry point. Looking at the broader context confirms the strength of this setup. The yellow line illustrates the historical significance of the support level over a longer time frame. We are not trading random momentum, we are trading a confirmed reaction to a significant structural point filtered by the SMA 50. This alignment is what gives the strategy its high probability. With the preliminary conditions met, let's define the long setup entry trigger. We do not enter immediately. Instead, we wait for confirmation of continued momentum by entering on the breakout of the high of the setup candle. To execute this, you simply place a buy stop order just above that high, and your stop loss will be placed just below the low of the same candle. This chart shows the entry point perfectly. The dashed line marks the high of our strong setup candle. By placing your buy stop just above this level, you ensure you only get triggered if the momentum carries through into the next trading period. This confirmation entry is vital for disciplined execution. Risk management is simple and effective. Your stop loss goes just below the low of the setup candle. This placement is strategic. If the price falls below the starting point of that strong buying candle, the entire trade idea is invalidated. This allows you to exit the market quickly and to minimize potential loss. Once you are in the trade, position management is key to locking in profit. The fundamental rule is to stay disciplined and always aim for a minimum risk-reward of 1-to-1. This ensures that even with a modest win rate, your system remains profitable. Beyond the 1-to-1, you have two flexible options for maximizing your gains. Your first option for maximizing profit is to use a trailing stop to follow the trend. On a daily chart, this is ideal for capturing massive multi-day moves. You can trail your stop loss beneath the SMA 50 or previous daily lows, allowing the market to run while protecting your accumulated profits. This example clearly shows the power of riding the trend. Here is the entry candle and the resulting explosive move. If you used a trailing stop, your trade management would simply be following the trend with the stop loss below the low of the preceding swing or candle, allowing you to capture the bulk of this uptrend. Your second option is to exit at predefined target levels. These fixed targets should be placed at previous significant resistance zones. Using this method provides a structured approach, allowing you to consistently bank predictable gains at points where the market has historically reversed, without being exposed to a potential trend reversal. Knowing when not to enter a trade is often more important than knowing when to enter. Avoid the trade if the candle has a small or unclear body, as this signals market indecision. Also, avoid it if the body is not entirely above the SMA 50, or if the market is clearly ranging. The final golden rule for all our trading is simple. If the situation isn't clear, don't act. This chart demonstrates the first filter. Avoid the trade if the candle has a small or unclear body. These are indecision candles, where buyers and sellers are balanced. Without a long body and small wicks, there is no strong momentum to confirm the move, so we stand aside and wait for a clearer signal. Here, the setup is invalid because the candle body is not entirely above the SMA 50. The moving average is cutting through the price action, which indicates a struggle, not a dominant trend. We use the SMA 50 to filter out these messy, low-probability setups, waiting for the price to clearly establish itself on one side. Finally, we avoid the trade if the market is ranging. The highlighted area shows the price oscillating sideways in a channel. The SMA 50 works best as a filter in trending or breakout environments, not in a sideways consolidation. Patience is your best trading partner. Wait for the market to choose a clear direction. Let's move on to the symmetrical short setup preliminary conditions. Just as before, we require a strong signal. A candle with a long body and small wicks, indicating strong selling pressure. Crucially, the entire body must be completely below the SMA 50 to confirm the downtrend. Finally, the candle must be reacting from a key resistance level. This is the mirror image setup, ensuring we only trade with strong bearish conviction. Here is the visual for the first short condition, the candle with a long body and small wicks. This strong red candle shows that sellers took control for the entire day, and the price closed near the low. We must see this undeniable selling pressure on the daily chart before we even consider an entry. The momentum must be confirmed by the SMA 50 filter. The entire body must be completely below the SMA 50 as shown here. This clearly confirms that the average is acting as dynamic resistance, reinforcing the downtrend. If the price is still crossing the SMA 50, we avoid the trade and wait for this clear separation. Finally, we look at the structural confirmation. The candle must react from a key resistance level. In this wider chart, the price moved up to the horizontal resistance line, was sharply rejected, and formed our strong setup candle below the SMA 50. This tells us that sellers are aggressively defending this key structural area. For the short setup entry trigger, we mirror the long strategy. We enter on the breakout of the low of the setup candle. This is a confirmation entry requiring the selling pressure to continue. To execute, you place a sell stop order just below that low, and your stop loss is placed symmetrically just above the high of the same candle. This visual shows the confirmation entry in action. The dotted line indicates the low of the setup candle. Your sell stop order is placed just below this line. Waiting for the market to move past this point ensures you are trading with confirmed momentum and avoid the risk of a false breakout. The stop-loss placement remains simple and logical. It goes just above the high of the setup candle. If the price reverses and breaks the high of this strong selling candle, the bearish scenario is immediately invalidated. This placement keeps your risk tight and protects your capital. The large green arrow illustrates the potential trajectory once the entry is triggered. By placing your entry on the low and your stop on the high of the setup candle, you maximize your potential reward relative to your risk. This clean structure is fundamental to the high-risk reward potential of this strategy, the short setup. Position management follows the same consistent logic as with our long trades. Maintaining symmetry is crucial for systematic trading. You must always target a minimum risk-reward of 1-to-1. This ensures that even if you only win half of your trades, you are still generating profit over time. For profit-taking, you again have two options. The first is to use a trailing stop to ride the trend. This is the best way to capture large moves during a sustained downtrend. The second is to exit at fixed target levels, which should be previous significant support zones. Choose the method that best suits your trading style and market conditions. This chart demonstrates the potential reward. By identifying key support zones from the past, you can set your profit targets, aiming for an excellent risk-reward ratio of 1-to-2 or more. The horizontal lines at risk to reward 1-to-1 and risk to reward 1-to-2 provide a structured way to take profits, maximizing your return from that tight stop loss. To complete our system, let's cover the short setup filters. When not to enter. As a momentum strategy, we must not enter if the candle is too small or uncertain. This indicates a balance between buyers and sellers, which is the opposite of the strong conviction we require. A weak signal leads to a low probability trade. This chart shows our first visual filter. Don't enter if the candle is too small or uncertain. We need a clear, long-bodied candle to confirm momentum. The small, choppy candles highlighted here show low commitment from sellers. We stand aside and wait for a decisive move that meets our strict requirements. Secondly, the body must be fully below the SMA 50. This example shows the price action being choppy and briefly crossing the moving average. This is a common trap. When the SMA 50 is cutting through the price, the market is not trending decisively, and we should avoid placing a trade. The final chart shows a clear example of an indecisive market. When you see price action bouncing sideways in a tight range, the market is in consolidation. The most crucial rule for the entire system applies here. If the situation isn't clear, don't act. Wait for the market to give you a clear, powerful signal. That concludes the SMA 50 momentum strategy. Thanks for staying with me throughout this entire guide. If you found this straightforward, visual strategy helpful, I have a few quick requests. Please give it a like to help support the channel and make sure other traders can find this simple, high-probability method. Also, don't forget to subscribe and click the notification bell so you don't miss our next strategy breakdown. And feel free to share it with other traders who are looking for a clear approach to the daily time frame. Finally, let me know in the comments. What do you think of this strategy? And what other strategy would you like me to cover? Thanks again for your time. Keep studying, keep improving, and happy trading.